All right. I have no idea how to change a mic once the stream is live. So unfortunately, I had to cancel the last one and start again. If anybody's out there, let me know if the mic is working. I don't want to get into my rambling thought process until we know the speakers are working. That's pretty frustrating. All right, let somebody join and let me know if you can hear me. I can hear you. You are so wonderful. All right, so let's get into this. Let's talk about the stock market crashing, potentially impacting real estate. I think that is going to be a topic that is discussed a lot out there, and I think it's one that you and I can get ahead of. Realize that this should take about 8 to 10 minutes, and then I'll spend the rest of the hour answering any and all questions. Get your questions in early because I will answer them top to bottom. If you get your questions in now, there's a very good chance I'll give a shot at giving you my opinion or answering them. So just put your questions in and we will go from there. So let's talk about stock market crash. And then let's talk about potentially of that rippling into real estate, because I think you're going to hear a lot of doomers talk about that exact thing. So let's talk about that. So again, why do we want to talk about the stock market first? Well, if you haven't learned anything by watching this channel over the last 5 years, the stock market moves first and it moves fast. Real estate is what they call inelastic, meaning you can't sell it quickly, but you can sell stocks quickly. So on Friday, given the unemployment rate jumped from 4.1 to 4.3, my back of the napkin math indicates that we have now tripped the SOM rule. The SOM rule goes into effect once we go over 0.5%. By my quick calculations, it's now 0.53. SOM rule triggered. Great. Now, give credit where credit is due. Meet Kevin highlighted, I think in a tweet, that the last time the SOM rule was triggered was 2001 and 2008. Why are those dates important? Well, first off, they were recessions. Second, you can go back and look at what happened to the stock market. The stock market in 2001 basically took 10 months, I think, to find a bottom. I think just pain. 2008, I believe it took 8 months to find a bottom, something like that. I'm going from memory. But the point is, we triggered the SOM rule Friday. And if the stock market behaves like the last 2 times, we are in for some pain in the stock market. What does pain mean? I don't know, 20, 30% perhaps. This is just going on history. I will, of course, be asking Dan Bird later today what he sees. He is the stock guy. I'm just a guy looking at history. But let's just say between friends, the stock market falls 30%. I think anything over 20% is a crash. So in this theoretical situation, the stock market has crashed 30%. Okay, great. What does that mean for real estate? Well, again, remember, real estate doesn't move as fast as stocks. There will undoubtedly be a wealth effect, right? If you lose 30% of your equity in stocks, that will hurt. You will behave different, right? The wealth effect is real, right? The richer you feel, the more you spend. The more your wealth, if you lose wealth, the less you spend. Perfect logic, makes perfect sense. The degree of the wealth effect is interesting because what will happen to housing? Well, I think you have to look at housing from 2 sides, sellers and buyers. Will there undoubtedly be some forced sellers? Absolutely. Recessions equal job loss. Recessions equal financial stress. Recessions, historically speaking, divorces go up, right? Financial strain. So there will undoubtedly be more forced sellers in a recession. There will also be people, because again, even if unemployment goes from 4.3 to 5.3, 6.3, we still have an employment rate of 94, 95%. Not many people take the time to think of the reverse, right? If unemployment is 5%, employment is 95%, right? Not many people talk about that. Why is that important? Well, the other thing that will undoubtedly happen in a recession is the Fed will be cutting rates, and likely cutting in a big way. I certainly hope we don't go back to zero. I think we've had enough of zero interest rates, in my opinion. But they'll go lower. There's arguably 200 basis points, maybe even 250 basis points in cuts that could be coming if the recession occurs and it's bad. So if you do that, you get some more margin compression, because even today at 6.4%, we still have a 265 basis point spread, which is above historical norms. Historical norms are 180 basis points. So if we cut that in half, let's take that from 260 to say 220. That gets us to 6%. We cut rates. We could have mortgage rates in the high fours if all hell breaks loose. Okay, great. We have a 95% employment. We have some more motivated sellers because of job loss, divorce, jobs transfers. We have a radically different affordability, right? If you take 2% interest or 2.5% off the mortgage rate, houses get a lot more affordable. So I suspect what will happen is housing will be roughly flat. I don't see a housing market crash occurring unless we get to 8 to 10% unemployment and we have that employment rate for a year. If we spike to 4.3 and we go to 7.5%, 8% quickly, say 3 months, the Fed will go back to zero. I mean, the Fed has no appetite for a 7% unemployment. Hopefully we don't go there. But we could certainly be going lower. There will certainly be opportunities made because, again, where there are motivated sellers, there are pain. I do think a lot of the motivation in discounting will be higher end. It'll be second homes. It'll be Airbnb busts. It'll just be where all the froth was. Unfortunately, until we build more entry-level homes, there's just nothing available. The other thing that you can't forget is if we whack 200 basis points off interest rates, we go from 6.5 to 4.5. Investors, you and me will find cash flow. How many of you have been waiting to buy an investment property? It gets a lot easier at 4.5. Wall Street, we've already know what Wall Street's doing, right? The hedge funds and all that. You think they're not going to be buying more? American Homes for Rent, all these other folks. We see 200 basis point drop in interest rates. Investors are going to come out of the woodwork. So at the end of the day, the stock market is not my thing. Again, given history, 2001, 2008, the Psalm rule makes sense to me. A recession is coming. It makes sense to me that we're going to see earnings deteriorate. We're going to see PE, price to earnings ratio, collapse. We're going to go from, I think, a 26 to an 18, price to earnings ratios, not unheard of. The stock market could be in for a world of pain. I'd ask you to go back and look at 01 and 08 just to see how long the duration is from top to bottom. And again, we'll talk to Dan Bird later today, a couple hours, and we'll ask him. But I just don't see a 6-month drop in the stock market of 30% bleeding into the housing market, unless unemployment goes to 7.5%, 8%, 9%. So I want to have that conversation. I know there's going to be a lot of doomers. Doomers are so funny. It's so funny. Like 3 weeks ago, rates are high, housing is going to crash. I already know they're going to say rates are low, housing is going to crash. I mean, guys, you can't have it both ways. I mean, really? Is that what we're doing here? Is that what we're doing? So, anyways. All righty, folks, like I promised, I want to go to your questions now. Can I scroll to the top? How do I do this? Let's scroll to the top. There we go. Right. So thank you for letting me know you can hear me. So Chris has the first question. Mike, in light of recent events, mortgage rates plummeting and probably continue to, has your let me try this again. Has your multifamily crash thesis changed? No. So if you don't know what he's referring to, I believe that the multifamily market is in for some pain. I think a lot of that pain is because of the debt structure. I do think 100 basis point drop in interest rates will bail a couple of people out, but the pain is so deep, so long, people are starting to give up. I don't see it saving multifamily unless banks or the Fed. I mean, if the Fed came out and they did something like a bank term lending program and they basically made commercial real estate loans money good, then yeah, that's what would change my thesis. At this point, we're still seeing multifamily trade discounts. We're seeing on the Real Deal, which is something I look at almost daily, talking about this or that multifamily being sold at a discount. I just think there was so much froth and so much bad debt, bad loans, that the pain is still coming. It's kind of like you can't, I don't know, what's they're saying? You can't put the horse back in the barn or whatever. I think it's already out. It's running, and it might shorten the duration. Maybe I was thinking this would bleed into 2026. Maybe it doesn't bleed into 2026. But yeah, there's undoubtedly a lot of pain coming. Undoubtedly. Lovetta, when the market prices in a Fed cut, how do we know this? What is the metric that tells us the market is priced in a rate cut? So there's what I would tell you to look at is Friday. I would actually just go to CNBC or your favorite business network and pull up the 10-year bond. The 10-year bond dropped. I can actually pull it up. Let me pull it up on my phone. I think it dropped 18 basis points on Friday. Let me see. Yeah, it dropped 18 and a half basis points on Friday. And I think on Thursday, it dropped like 11 basis points. So what it tells you the market priced it in, they've already cut the 10-year a quarter, actually more than a quarter. So that's the market pricing in a rate cut. It happens that fast. A lot of people don't realize, they're like, hey, the Fed cut rates, mortgage rates should go down. That's not how it works. Unless the Fed truly surprises the market, which they try not to do, that mortgage or that rate cut was already priced in. And what we saw Thursday and Friday in the 10-year note, and thus mortgage rates, tells you the pricing in a cut. You can actually go back to mortgage rates. You can pull up Mortgage Business Daily, I think on Wednesday. Or actually, you know what, too? You can go follow Lance Lambert on X or Twitter. I think every day Lance puts out the mortgage rate. And I think if you pull up Lance Lambert on Monday, mortgage rates were like, I don't know, 6.8, something like that. And on Friday, they're 6.4. So the market priced in a cut, clearly priced in a full cut. The question now is, will the market price in a half? I talked about this on the daily financial news just this morning. The market, as of yesterday, it could have changed today, but as of yesterday, it was pricing in a 71% chance of a 50 basis point cut in September. Yeah, pretty crazy. So that's what I would look at. Good morning. Good morning. The Psalm rule. What is the Psalm rule? So the Psalm rule, forgive me, I don't remember her first name. I should probably pull it up. She's an economist. Let's give her credit. What is the Psalm rule? And Psalm is spelled S-A-H-M. If you want to look it up, want to do some research. And her name, let's give credit where credit is due. Tell me who created this thing. Psalm rule. Come on, guys. Stop giving me the definition. Wow, I guess I got to type in who. I think it was Loretta. No, Claudia. Claudia Psalm. Let's give Claudia some love. So basically, the SOM rule is a calculation of unemployment rate. Really, it's a calculation about rate of change. That's really what the SOM rule is saying. Is the SOM rule identifies an acceleration rate of change in the unemployment rate. And what it does is it takes the 3-month average, so the last 3 months. And if the SOM rule if the current unemployment rate is 50 basis points higher than that, you have triggered recession. And because again, it's showing that once unemployment starts really moving, it really starts taking the elevator, not the stairs. So it's a rate of change. And yeah, Claudia Psalm, that's hers. So let's give her some love for that. And it's been remarkably accurate. It's been remarkably accurate. I think it's indicated a recession. I think it's like 8 for 8 on recessions. Let's see. 1, 2, 3, 4, 5, 6, 7. Yeah, I think it's 8 for 8, the SOM rule recession indicator. So she has something there. What is SOM rule? All right. I have $400K in equity in my primary. Ooh, 2.25. Good for you. If rates get to the 3s, I was thinking of a cash out refi to buy more properties. So I can only tell you what I would do. Actually, I'll do you one better. I only can tell you what I did. This is not financial advice. This is just what one guy did. So while we were in growth mode, we got an equity line on our home. We didn't do a cash out refi. We got an equity line. And we would only use that equity line if we found a great deal and we had no cash or ability to buy any other way. Once we used our equity line, I was out of the game. I could not buy anymore. My sole goal once we used our equity line was to pay off the equity line. And that was a rule that Olivia and I came up with. I didn't want to put our family home at risk. I didn't want to miss a great deal. So the idea was, hey, if you're going to use this, last silver bullet, equity in our home, you're done until you pay it off. So again, I think we used it, 3 times, maybe 4 over a decade. So we were in growth mode, and that's what I chose to do. I chose to use that. I would probably have a very hard time giving up my 2.25 interest rate. I mean, that's below inflation. That's like free money. I think a 2.25 30-year fixed rate loan is like untouchable to me. I mean, why would you touch that? I would get an equity line, even if the equity line was 5%, 6%, 7%. If the deal's good enough, do it and then pay it off. That's just one guy's opinion. Wow. Currently cash flowing an 8% commercial, 30-year fixed, rock star. Just think about it, right? You get that down to 5.5, you're printing money just because the mortgage rate dropped. That's crazy. Do you think it's best to buy something now with the expectation that refinancing to a much lower rate will be possible in 12 to 18 months? It's not how my brain works. I don't gamble. I only close a deal if it makes sense today. I don't play that woulda, coulda, shoulda, hopefully stuff. I do the best chance I can to get a deal today. It must cash flow today. It must perform today. And hey, if mortgage rates get better, great. If they don't care. So I don't think that way, KG. Yep, that's the definition. Yep, thank you. Hey, financial firefighter. We got an accountability group today, 12:30 in the school community. Folks, if you haven't joined school and you have any interest in real estate, let's just be honest, you're missing out. $20 a month. You get 2 accountability calls a week. one on Wednesday, one on Sunday. You get at least one millionaire conversation a week. I go live in there twice a month, only in there twice a month. There's a 10-week boot camp that's $1,000. There's six hours of seller financing. If you have any interest in real estate and you're not in there, just silly. And at this point, we're over 210 members, and the community, everything I do is to try to build a community of go-givers. And now that we're over 210 people, the community it's building itself. You should find friends. You should find your own accountability. It's like going to the gym. You should find the people that you're rocking with, right? The other thing you got to remember is there's a lot of doom out there, and some of your friends suck. You need to find other people doing this. And that's why I love the school community. That's why I love this February event, right? We have a February event happening in Vegas, 400 people, maybe 450 people, all going the same direction. 2-day event. We're going to have lots of the millionaires. I'll have a couple of surprise guests, 6 hours of networking. Every speaker you're going to have a chance to interact with and ask questions. It is, it's going to be amazing. I hope you're there. Tickets are on sale. We've sold 10%, I think, already. This will sell out. General admissions $299, VIP $699. So yeah, you join school or join the event. It's going to be something pretty special. All right, let's go to the questions. I forget. Oh, I was saying hi to people. Are we going to see a second wave of high inflation? Ooh, that's a good question. So let's talk about the first wave. Let's talk about the first wave first, because I think we have to understand the first wave to make a call about the second wave. And first off, let me be clear. That's one of my biggest risks, is that we would repeat 1980 and 81. If you don't know about 1980 and 81, you haven't studied economics, because that sucked. 1981 was the least affordable housing market in the last 55 years. Crazy. Not today. 81 was horrible. And it was that second wave to this question. But again, I digress. Go back to the first wave. In my opinion, our first inflation wave, which took us up to 9.1, if memory serves, was caused by a couple of things. First, we essentially shut down the world economy, which caused a hopefully once in a lifetime screw up in our supply chains. So we greatly reduced supply of stuff. Okay, great. Second, we started sending money to people and telling them not to pay their bills. So you have a lot of less stuff and you have more money and you have access to the internet and shopping and all of that. So I think the first wave was caused by supply disruption and free money. So let's talk about the second wave. The first question I have is, will we make that same stupid decision about our supply chain? I think the answer is no. I think history has showed that was dumb. First off, let me just note, if World War III breaks out, everything I'm saying goes out the window. World War III, bad. And according to some people, we're getting close to that. But let's just say that doesn't happen, because that would be horrible to put out in the universe. So I don't think we're going to have the same supply disruption. Okay, great. Then we go back to free money. Could our politicians give out free money again? Of course they can. That's like their answer to everything. The question I have is, how bad would it have to get for free money to start rolling again? And I don't know that answer. That said, it's not impossible. I would say it's unlikely. And maybe that's more of a hope, and maybe that's just more of a hope. But that said, I think the other thing that's an interesting thought exercise is, I think inflation will be higher like the average inflation will be higher this next decade than the last decade. If memory serves, going into COVID, inflation was struggling to get over. I think it was like 1%, 1.2. It was way below 2%. So I suspect the next decade, it would not shock me if inflation averages 2.2, 2.4, because I still think we have a lot of money in the system. You can't print 40% of the dollars in a 4-year window and have that out of the system that quickly. You can't onshore more manufacturing, which clearly we are trying to do, without more inflation. It costs a lot more to pay a US employee than an employee in China. It's just math. So I do think we're going to have a higher inflation, average inflation over the next decade. But, and again, this could just be a hope. I hope we don't repeat 81, because the only answer, if we do get a second wave of inflation, and let's say it doesn't go as high, but it goes to 6.5 instead of 9.1, is you're going to have to Paul Volcker this thing. And what does that mean? Well, today I think we took the rates up to 5.25 to 5.5. They would probably have to take rates to 8% or something. That would crush a lot of businesses, small businesses, and the like. So, I think you're asking the right questions, and I guess my answer is I hope not. Where do we got? Oh, second wave. Credit tightening is going to make it hard to buy a house. Interest coming down is not bullish for real estate. Interest rates coming down is not bullish. Okay. Real estate is a commodity. Like every commodity, there are bull and bear cycles. Okay. Okay. We can disagree. That's fine. Yeah, I'm not going to talk about my portfolio. Not on the internet. I'll save that for the Vegas event or school. I'll do it inside school. The last bear cycle, this is, I think, is real estate, was 2020. Before that, it was 09 to 11, 90 to 92, 81 to 82. If you bought during those years, you always made money in real estate market. Oh, I think I know what he's saying. Okay. Yeah. I don't know. I have a 54-year spreadsheet. That makes sense to me. I think if you, Logan actually puts this out from Housing Wire all the time. I think if you go back and look at real estate, again, these are on nominal, not real, right? And if you don't know the difference, we should study that, nominal versus real. On a nominal basis, real estate on a national level has gone negative like 5 years over the last 50, and 3 of those years were the Great Recession. I think there was a small drop in 82. It was 81 or 82. And then another year, I think in the 70s. But yeah, usually housing is a lot stickier than the average person thinks as far as median price goes. Yeah. A 50% decline in real estate. Okay, I'll take that bet. I will take that bet. 50% decline. Man, did Reventure Consulting join my stream? Now let's talk. So let's have this conversation. Could a real estate market crash 30 to 50%? Absolutely. Absolutely. Could Austin, could Miami, could I don't know, any market could crash 30 to 50%. You're absolutely right. Absolutely right. Given history, and I've studied it all the way back to 1970, a 30% crash in national home prices is highly unlikely. Highly, highly unlikely. In fact, the worst crash I recall, and it was the Great Recession in a single year, was 8.9% from year to year. So when people say housing could crash 20, 30% in a year, it's never done that before. Never done that before. Could it do that over years? Sure. I think the Great Recession had 3 negative years, negative 8.9, negative 5.5, and negative 3, something like that. I don't know. Let's add that together and call it 23%, like cumulative. That was a recession because of housing, because of the debt. It's not where we are today. The debt market is completely different. I mean, it's hard for me to envision a 30% crash in the national median home price. 30%. I mean, what would have to happen? Unemployment go to 10%, World War III. But every time you talk about these black swans, what happens? The Fed goes to zero. The money printer goes burr. The federal government starts stimulating the hell out of everything. Free money shows up in your mailbox. Don't we know how that movie ends? Yeah. The last thing I'll say about real estate, because I'm not a housing bull. I mean, I've already told you, I think transactions are going to break the low of 3.88. I think we've had a decade of appreciation in 2 years. So I'm not here calling for appreciation. I hope real estate is flat for 4 years, 5 years. The absolute worst thing that could happen. Here's my worst case scenario. And I'll tell you exactly what Olivia and I would do. So let's play this out for a little bit. So we already had the Psalm rule break Friday. We saw the stock market drop 800 points. Let's say the stock market drops, 30%. Then we have an election. And then we get to January of 25. New president sworn in because the old guy's not running. So we have a new president, either side, don't care. We have a new president. The economy's in terrible state. We're in a recession, probably an ugly one. What do you think a new president's going to try to do in their first year in office? I think they're going to try to get us out of a recession. So they're going to berate, they're going to beat up, they're going to get the Fed to lower rates. We get mortgage rates in the 4s. We start doing jobs acts and this, that, the other thing. Try to get unemployment rate to go the other way, because now it's sitting at 7% in this theoretical exercise. And we start getting out of this. What happens to the low end of the housing market? Because builders aren't building. Well, my worst case scenario is the low end, where most of us are investing, goes up 5 to 15%, depending on your market. Let's say it's 10% just for easier math. I think the median home price today is what, like 430, something like that, 400. Let's call it 400 because it's easier math. Median home price goes up 10%. That then takes it from 400 to 440. I mean, at some point, you just start. It just prices get stupid. You get affordability crashes like 1981 again. It's just, I don't want to see it. I do not want to see home prices jump again. And let's be clear, if my market goes up, say 20% in the next 2 years, which again, I hope not, and I'm not calling, we're just doing a what if here. If it goes up 20%, there's a very good chance we sell everything. And if you guys don't know what I'm talking about, I've done this before. In 2006, we sold all of our houses because real estate got stupid. If my market goes up 20%, 25% from here, real estate will be stupid and I will sell everything. I will raise ungodly amounts of cash and I will just wait on the sidelines for this crazy thing to explode. Again, my call is flat, but I'm sitting here going, if the dominoes fall the wrong direction and we get a very stimulative, first year in office, we get crazy low rates, this thing can get wacky. So, yeah, that's what I'm thinking. The crash and the correction, yeah. You're welcome. Michael, I hope sounds like you're selling your real estate. Good luck. I hope you're right. I hope you're right. Hey, All Nighter Hiders here, back from Alaska. How you doing, man? Only buy great deals for every early house hacker. I think your average deal cash flow is okay considering 1 year rule. Sounds right to me. So let's think about this. Ironwood saying that inflation hits many years later, 5, 10, 15 years after the money was printed. By the time you start seeing job loss, you know it's starting to hit from the time it was printed. We are certainly starting to see job losses. I'm with you there. People were making money in the 80s in real estate. What are people talking about? I'm not sure. I'm not sure where we went sideways. Yeah, 1981 was. I mean, if you're in real estate, you're a real estate investor, I would ask you to study 1981. 1981 was an amazing year. Why was it amazing? Well, mortgage rates were 18%. 18. And yet we still did roughly 2 million transactions. Now, if you go back and study 1981 and you read books, you read Sam Zell's biography, rest in peace. You read Robert G. Allen's original book, which I actually spent $100 buying the original first edition. You realize that we did 2 million transactions, but not everybody got a mortgage rate. We had a lot of creative financing. 1981 was a year creative financing really took off. Right. So I would ask you to study 81, 82, maybe 83 if you're interested in real estate. It's an important time to think about. Should I buy my family a house this week or leave my cash in the bank? 500K purchase. Michael, what I tell everybody, I give everybody this answer, and this is not meant to be flippant. This is actually what I think. If you're asking somebody on the internet, myself included, if you should buy a home, the answer is you shouldn't buy a home. It should be a no-brainer. It should be what you want to do. It should be all of you. Anybody given, somebody financial advice on the internet, I don't tell anybody to do anything other than do the work. You should just do the work, know your buy box, know your numbers, know what you want for your family and your future. I have no idea if you should buy a home, but it's probably not if you're asking a guy on the internet. That's generally how I answer that question. Do you invest in stocks, gold, Bitcoin, or are you 100% real estate? I have been very clear. I have 1% of my net worth in Bitcoin or crypto, Bitcoin, Ethereum. I have it as an insurance policy. I have a little bit of gold, a little bit more, or a lot more of silver. Yeah, and cash. What else we got? During a recession, real estate's not going up? Wow. Somebody's not looking at the charts. Real estate's gone up. All of the recessions except the Great Recession, at least the last 50 years. We've had, how many recessions have we had since 1970? Hey Siri, how many recessions have we had since 1970? 1, 2, 3, 4, 5, 6, 7. So we've had 7 recessions. And again, I think over the last 54 years, real estate's had like 4 negative years, and 3 of those were because of the Great Recession. So no, that's not true. Michael, good. I'm glad you appreciate the answer. That was meant with affection. It was not meant as a slight. It's just, if you're asking somebody on the internet if you should buy a home or frankly any investment, it's like, hey, you're not ready. You got to get, you got to be comfortable, because you're the only one that's going to reap the reward or pay the price. So I'm glad it was received in the manner it was intended. Are you going to the real estate free for all in Gary? It's a great value. Oh, by the Olson Group. I know Tom. No, I'm not going. I was invited to speak there one year, then COVID happened and it never happened. I never was invited back. But yeah, I met Tom. I actually went, he invited me to his mastermind. God, when was that? 2019, I think. Yeah. So I think I got all the questions. Let's see. Yep. I think I got all the questions. All right, guys. Again, we'll just close out talking about 2 things that are important to me. One, school, one rental at a time school, $20 a month. 2 accountability groups, 200 plus, 210 plus folks talking real estate every day, asking questions, networking. You have to find your tribe. You have to find your people. I have worked very hard to create a community at One Rental at a Time that is full of very good people doing the work. We speak the same language. We talk buy box. We talk cash on cash or yield. We talk self-manage, property managers, out of state. We have people looking at inspection reports. We have deal structures. We have brainstorming. It's just the spot to be. My aim for our school community is I want to be a top 100 school. I think today we're the top 750. I want to get to 1,000 members. Today we're at, I think, 210. I'm going to do everything I can to keep adding value every week, bringing you more and more live discussions. If you go to school and you go to classroom, right, that's where you find the 10-week boot camp, the 6-hour masterclass on creative financing. But there's also a thumbnail that says special guest. It's if you find that thumbnail, you click on it. There's already like 30 recorded conversations with millionaires. We got Henry Washington, Lance Lambert, April Crosley, Anna Kelly. And all these conversations are only in school. There's hours and hours and hours of content for you to consume. Also, the important thing about school is I give you the access to ask questions. You want to know something from Anna Kelly? Great. You want to know something from the lumberjack? Great. I give you the opportunity to ask questions. So again, school is stupidly priced at $20 a month. Join, meet new people, find new friends, go. And then we'll talk about the Vegas event. I actually printed out my notes. These are all my notes from the last Vegas event. I'm just going to go over some things that I know I'm going to change. So first and foremost, we're going to feed everybody. Last time, general admission, I supplied like a food truck. I didn't like how long the line got. So this time I'm going to feed everybody. So there'll be multiple food stations for VIP and for general admission. That will allow people to network freer, and I won't be so stressed out. Next, we're going to have what I'm just going to generally call room monitors. Last time I was running around, I'm going to try to find 2 or 3 volunteers, probably make them wear purple shirts so they're easy to stand out. So if you need help, it'll be easy to find folks. We're going to keep doing the Q&A. I loved how we had open questions from the audience. That's something that makes my events very unique. We're going to allow you to ask questions of all the speakers. Next, we're going to do name tags. We're absolutely going to do name tags. We're going to probably have 2 lines. I'm asking my team to create specific name tags. One is obviously your name, but second, your YouTube name. Now, because there's a lot of people that interact on my channel daily or weekly that will be at these events. So I'm going to ask you to put your YouTube name down so people can meet you because they interact with you in the comments. So that will give you the ability to meet the people you interact with. Next, there was some feedback about the chairs, right? Because we did do a lot of sitting. So I'm spending some extra money to make sure the chairs have cushions this time. So that will be interesting. I will create a spot, hopefully, for if you have a YouTube channel that you want to market, and I'm going to try to plan to call those people up on stage to say a few words so you have a chance to market your YouTube channel. I already have some ideas of new speakers coming. Those that want to hear from Olivia, which is often a frequent request on this channel, she has said that she's going to talk this time, so she's going to have her own discussion. You'll be able to ask her questions, which it should be fun. What else do I want to talk about? Yeah, I think that's good. Yeah, that's good. I got 2 pages of notes. That's just a little taste of what's coming. Let's see if there's any other things going on here. Thanks, all-nighter. Try to get Mark Moss someday. He's a good. I like Mark. I watched some of his stuff. I don't know. Have I ever spoken to Mark? I don't think I have. I don't think I've spoken to Mark. Have I spoken to Mark? I don't think I have. Thanks, all-nighter. All right, guys. Take care of yourself. Have a wonderful day. Be well.